Preparing for a financial analyst at Publix interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Publix? I am attracted to Publix because it combines a strong retail brand with a disciplined, employee-owned culture. A financial analyst can directly influence decisions involving pricing, labor, inventory, capital spending, and store performance. I enjoy turning detailed financial information into practical recommendations, especially in a business where small improvements can scale across hundreds of locations. Publix's long-term perspective also appeals to me because it encourages thoughtful analysis rather than chasing short-term results at the expense of customers or associates. While answering, focus on Publix's strong retail business, employee ownership, customer service culture, disciplined operations, and how your analytical skills can support profitable decisions across stores, merchandising, supply chain, or corporate functions. Question 2. Walk me through your approach to analyzing a retail business. I start by separating revenue performance from profitability. I review comparable store sales, transaction volume, average basket, category mix, and pricing. Then I analyze gross margin, shrink, labor productivity, occupancy, distribution costs, and other operating expenses. I compare actual results with budget, prior year, and forecast, investigating material variances rather than simply reporting them. Finally, I connect the findings to cash flow and operational actions, such as changing promotions, staffing, assortment, or inventory levels. Make sure to cover sales growth, comparable store sales, traffic, basket size, gross margin, labor, shrink, inventory turns, operating expenses, cash flow, and comparisons against budget, prior year, and relevant benchmarks. Question 3. What retail metrics would you monitor most closely at Publix? My core dashboard would include comparable store sales, transactions, average basket, gross margin, shrink, labor cost as a percentage of sales, inventory turns, in-stock rates, and cash conversion. I would also track department and store-level profitability because aggregate results can hide underperformance. For example, strong sales growth with declining margin may indicate excessive promotions or unfavorable mix. The most useful metrics are those that connect financial outcomes to operating drivers and help managers take timely corrective action. In your answer, talk about comparable sales, transactions, average ticket, gross margin, shrink, labor cost percentage, inventory turns, in-stock rates, EBITDA, cash conversion, and how metrics differ by store, department, and region. Question 4. How would you explain a favorable or unfavorable variance to a business leader? I would begin with the headline variance, quantify its impact, and explain the operational drivers in plain language. For sales, that might mean separating price, volume, mix, and timing. For expenses, I would distinguish rate, usage, headcount, and one-time items. I would validate the explanation with the relevant business partner, assess whether the variance is recurring, and provide an action. My goal is not merely to describe what happened, but to clarify what management should do next. Be sure to mention materiality, clear decomposition into price, volume, mix, timing, and rate drivers, validation with operating partners, concise communication, and a specific recommendation or next action. Question 5. How would you build a monthly forecast for a supermarket business? I would build the forecast from operating drivers rather than applying a broad percentage to last year's results. Revenue would reflect store count, comparable traffic, average basket, pricing, seasonality, and category mix. I would forecast gross margin using procurement costs, promotions, and mix, then model labor and expenses based on staffing, wage rates, occupancy, distribution, and known initiatives. I would compare the forecast with actual trends, document assumptions, and maintain upside and downside scenarios for major uncertainties. Focus on a driver-based model using store count, comparable sales, traffic, basket size, category mix, seasonality, margin assumptions, labor, shrink, expenses, capital spending, and documented risks and opportunities. Question 6. What is the difference between budgeting, forecasting, and planning? A budget is usually an approved annual financial target used to allocate resources and evaluate performance. A forecast is a current estimate of what the business is likely to achieve, updated as conditions change. Planning is broader and connects multi-year strategy with investments, capacity, stores, people, and financial objectives. In practice, I would use the budget as a baseline, the forecast as a decision tool, and strategic planning to test whether short-term actions support Publix's longer-term priorities. While answering, distinguish the annual commitment represented by a budget, the updated estimate represented by a forecast, and the longer-term strategic framework represented by planning, including how each supports management decisions. Question 7. How would you analyze a store's declining profitability despite stable sales? I would first bridge profit from the prior period to the current period, separating gross margin and operating expense impacts. Stable sales could still produce lower profit through unfavorable product mix, heavier promotions, higher supplier costs, shrink, waste, or increased labor rates and hours. I would compare the store with similar locations and investigate whether the issue is temporary or structural. The conclusion should lead to action, such as adjusting schedules, assortment, pricing, inventory controls, or waste procedures. Make sure to cover gross margin pressure, product mix, promotions, shrink, labor hours and rates, occupancy, supply chain costs, waste, one-time charges, and comparisons with similar stores. Question 8. What is comparable store sales growth, and why is it important? Comparable store sales measure revenue growth from stores operating in both periods, helping isolate underlying performance from expansion or closures. I would decompose the result into traffic, average ticket, pricing, and mix. A positive number can still be less encouraging if it is driven only by inflation while transactions decline. I would also consider cannibalization, calendar effects, and regional differences. Used with margin and traffic data, the metric provides a clearer view of customer demand and store productivity. In your answer, define comparable store sales, explain why excluding newly opened or closed stores improves comparability, and discuss traffic, ticket, pricing, mix, cannibalization, and limitations of the metric. Question 9. How would you evaluate the profitability of a promotion? I would compare promoted sales with a realistic baseline, not assume every unit sold was incremental. The analysis would include discount depth, unit volume, gross margin dollars, vendor funding, cannibalization of other products, basket impact, and any waste or inventory benefits. I would also examine whether the promotion attracted new or returning customers. A promotion can increase revenue while destroying profit, so I would recommend it only when incremental contribution and strategic customer benefits justify the cost. Be sure to mention incremental volume, baseline sales, discount depth, gross margin dollars, vendor funding, cannibalization, basket effects, customer acquisition, inventory availability, and post-promotion profitability. Question 10. How would you assess the financial impact of food inflation? I would separate the impact into cost inflation, pricing recovery, volume response, and mix. If supplier costs rise, higher retail prices may protect margin dollars but reduce units or shift customers toward lower-priced products. I would model several elasticity scenarios and compare Publix's pricing with competitors. I would monitor both gross margin percentage and dollars because they tell different stories. The analysis should help determine where to absorb costs, where to reprice, and how to protect customer value. Focus on supplier cost changes, retail pricing, unit elasticity, mix, gross margin percentage and dollars, customer behavior, private label effects, competitive pricing, and scenario analysis for management decisions. Question 11. What would you do if inventory increased while sales remained flat? I would determine whether the increase reflects a deliberate seasonal build, timing issue, higher safety stock, or a genuine slowdown in inventory productivity. I would review days on hand, turns, aging, category mix, purchase orders, in-stock rates, and slow-moving items. Excess inventory may create markdowns, shrink, storage costs, and tied-up cash, while insufficient inventory can lose sales. I would partner with merchandising and supply chain to adjust orders, promotions, replenishment settings, or assortment decisions. Mention inventory turns, days on hand, purchase timing, safety stock, seasonal build, assortment changes, slow movers, in-stock performance, working capital, shrink, and coordination with merchandising and supply chain teams. Question 12. How would you perform a capital budgeting analysis for a new Publix store? I would forecast the store's incremental cash flows, beginning with land, construction, equipment, technology, pre-opening costs, and working capital. Operating assumptions would include sales ramp, traffic, basket size, gross margin, labor, occupancy, shrink, maintenance capital, taxes, and potential cannibalization of nearby stores. I would calculate NPV and IRR using an appropriate discount rate, then test downside cases for slower ramp or lower margins. I would recommend approval only after reviewing strategic fit alongside financial returns. In your answer, cover initial investment, land and construction, equipment, pre-opening costs, sales ramp, margins, labor, cannibalization, maintenance capital, taxes, cash flows, NPV, IRR, payback, and sensitivity analysis. Question 13. Explain the relationship between the income statement, balance sheet, and cash flow statement. The income statement shows performance over a period through revenue, expenses, and net income. The balance sheet shows resources and obligations at a point in time, including inventory, payables, fixed assets, and equity. The cash flow statement explains how cash changed through operations, investing, and financing. For example, inventory growth can reduce operating cash even when sales are strong, while depreciation lowers accounting profit without using current cash. Understanding these links helps me assess both earnings quality and liquidity. Make sure to explain profitability, financial position, and cash movement, connect net income to operating cash flow, and discuss inventory, payables, depreciation, capital expenditures, and retained earnings. Question 14. How would you use Excel or financial systems to improve an analysis? I use Excel to create transparent, auditable analyses rather than complicated files that only I can understand. I structure source data consistently, use pivot tables and lookups for analysis, and apply checks for missing records, duplicate stores, and unexpected totals. For recurring work, I would use Power Query or system extracts to reduce manual effort. I separate assumptions from calculations, document sources, and test outputs against known results before sharing recommendations. Discuss clean data structure, formulas, pivot tables, lookups, Power Query or equivalent tools, controlled assumptions, error checks, sensitivity tables, automation, documentation, and protecting output quality. Question 15. Tell me about a time your analysis changed a business decision. In a prior project, a team planned to increase inventory for a promotional period based on prior year demand. I analyzed store-level sales, current inventory, supplier lead times, and promotion performance, then identified that several locations already had excess stock. I recommended reallocating inventory and reducing the purchase order rather than increasing it uniformly. The team lowered working capital and markdown risk while maintaining availability. That experience reinforced the value of combining financial analysis with operational context and practical execution. Be sure to present a clear situation, analytical method, quantified finding, stakeholder communication, decision taken, measurable result, and lesson learned, using the STAR structure without overstating your contribution. Question 16. How would you handle conflicting data from finance and operations? I would avoid assuming either source was wrong and first reconcile definitions, reporting periods, store populations, and accounting treatments. Differences may come from accruals, timing, returns, transfers, or separate system refreshes. I would trace both numbers to source data, quantify the variance, and involve the process owner when needed. Once resolved, I would document the agreed methodology and add a control to prevent recurrence. Maintaining credibility requires accuracy, transparency, and respectful collaboration. Focus on clarifying definitions, periods, store populations, accruals, source systems, timing, reconciliations, materiality, respectful communication, and documenting the final agreed methodology. Question 17. How would you prioritize multiple urgent requests from different stakeholders? I would quickly rank requests by decision deadline, financial materiality, business impact, and dependency on other work. I would clarify the desired decision and level of precision rather than treating every request as equally urgent. I would communicate trade-offs early, provide a reliable preliminary view when appropriate, and set realistic delivery times for deeper analysis. If priorities conflict, I would ask my manager to confirm sequencing. This approach protects quality while keeping stakeholders informed and supported. In your answer, discuss business impact, deadlines, decision dependency, data availability, effort, materiality, communication, negotiated priorities, and delivering a reliable preliminary view when a complete answer needs more time. Question 18. What would you do if a manager asked you to present an overly optimistic forecast? I would respectfully ask which assumptions support the optimistic view and compare them with historical trends, current data, and operational capacity. I could present an upside scenario, but I would clearly distinguish it from the most likely forecast and show the sensitivity of key drivers. If the request involved misleading stakeholders or unsupported numbers, I would not alter the analysis improperly. I would explain the risk, document my work, and escalate through appropriate channels if necessary. Mention integrity, objective assumptions, documented evidence, scenario ranges, sensitivity analysis, constructive challenge, escalation when necessary, and separating management targets from the most likely forecast. Question 19. How do you ensure accuracy and maintain strong internal controls in financial reporting? I build accuracy into the process through reconciliations, independent reasonableness checks, controlled source files, and clear review responsibilities. I verify that totals agree with the general ledger or approved system extract, investigate material exceptions, and preserve supporting documentation. I also use version control and restrict access to assumptions or submissions where appropriate. If I find an error, I correct it promptly, assess whether prior reporting is affected, and improve the control rather than simply fixing one output. Be sure to cover reconciliations, source validation, segregation of duties, approval evidence, variance reviews, access controls, version management, exception reporting, documentation, and timely correction of errors. Question 20. What questions would you ask your interviewer at the end of a Publix Financial Analyst interview? I would ask which decisions the team most wants this role to improve, which metrics define success, and how analysts partner with store, merchandising, supply chain, and corporate leaders. I would also ask about the reporting and forecasting cadence, primary systems, and expectations during the first 90 days. Finally, I would ask how the team supports development and reflects Publix's employee-owned culture. Those questions help me understand both the technical responsibilities and the behaviors needed to succeed. Focus on the team's priorities, key performance indicators, stakeholder relationships, reporting cadence, systems, expectations during the first 90 days, development opportunities, and how analysts demonstrate Publix's ownership culture. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.